Global trade appears to know no borders. Cargo ships cross oceans. Capital moves between continents. Markets open in Tokyo, close in New York, and begin trading again in London before most people even wake up. It feels like everything is flowing seamlessly. But the reality is not so simple. In moments of tension, choke points can suddenly turn into suffocating centers. These are not just narrow passages on a map, but leverage points that direct capital, supply, and power. Nearly 1/5 of the world's oil passes through a waterway only about 21 miles wide. A single canal in Egypt carries more than 10% of global trade. In 2021, a single container ship ran aground and blocked the Suez Canal for 6 days, effectively freezing nearly $10 billion of commercial activity per day. The global financial system may operate through screens, spreadsheets, and satellites, but it still has to pass through narrow corridors of land and sea. And when those corridors tighten, the flow of money tightens as well. Welcome to the Economic Historian, the place where money, power, and history collide. And here, nothing is ever as simple as it first appears. This is the story of why strategic choke points have always shaped global finance. Not just wars or empires, but inflation, currency dominance, sovereign debt, and global crises. Because when geography narrows, leverage concentrates, and leverage under pressure eventually becomes power. The greatest illusion of globalization is the belief that everything is connected evenly and equally. In reality, trade flows through specific arteries, and arteries can be blocked. This pattern is not new. It is ancient. In the 5th century BCE, the narrow passage, known as the Hellespont, connecting the Aegean Sea to the Black Sea, became a strategic obsession for the Persian Empire. Xerxes famously constructed pontoon bridges there during his campaign against Greece in 480 BCE. Controlling that strait meant controlling grain shipments from the Black Sea region, shipments that were vital for Athens. This was not merely a military maneuver, it was a matter of economic survival. Athens depended on imported grain. Disrupt that flow and food prices destabilize. Destabilize food prices and the state itself becomes unstable. Geography created leverage. Leverage created conflict. Conflict reshaped power. Now fast forward 2,000 years. In 1869, the Suez Canal opened under French and Egyptian initiative. It dramatically shortened the maritime route between Europe and Asia and eliminated the need to sail around the Cape of Good Hope. Voyages that once took months became weeks shorter. Costs fell and trade accelerated. But canals do more than reduce distance. They concentrate power. The British Empire quickly understood what Suez meant. India was the crown jewel of the empire, and Suez was the shortest route to it. In 1875, when Egypt's ruler, Ismail Pasha, was crushed under mounting debt from modernization projects, Britain purchased a controlling stake in the Canal Company. This was not philanthropy. It was strategy. Control of Suez secured Britain's access to Asian trade and reinforced London's position as the center of global finance. When trade flows and colonial capital pass through your shipping lane, your currency strengthens. Your banks benefit. Your insurers benefit. Sterling dominance was not abstract. It was built on maritime power. By the end of the 19th century, London had become the world's financial clearing center. Trade bills were settled in sterling. Insurance contracts were written in sterling. Sovereign debt was issued in sterling. But then, the mid-20th century arrived. In 1956, Egyptian President Gamal Abdel Nasser nationalized the Suez Canal, challenging British and French control. Britain, France, and Israel launched a military intervention. However, the United States, concerned about Soviet escalation and financial instability, forced Britain to withdraw. This crisis revealed a deeper truth than a simple diplomatic dispute. Britain was no longer the undisputed financial hegemon. Its foreign reserves were limited. The pound came under pressure. The United States refused to support sterling unconditionally. As a result, Britain was forced to retreat both militarily and financially within weeks. The Suez Crisis became a symbolic turning point in the decline of the British Empire. Geography shifted, power shifted, finance followed. When Britain lost secure leverage over Suez, its ability to project financial dominance weakened. The rise of the dollar accelerated. Controlling a canal influenced the currency itself. But canals are only one form of choke point. Energy is another. The Strait of Hürmüz lies between Iran and Oman and connects the Persian Gulf to the Arabian Sea. Roughly 20% of global oil consumption passes through it every day. This is not just a statistic, it is a pressure point. In 1973, following the Yom Kippur War, OPEC imposed an oil embargo on the United States and other Western countries. Oil prices quadrupled within a few months. Energy-dependent economies experienced both an inflation surge and economic contraction at the same time. The era of stagflation, combining high inflation with high unemployment, shattered post-war economic assumptions. This was not caused solely by reckless money printing. It began with supply restriction in a geographically constrained region. When oil supply tightens at a choke point, energy prices rise. Energy feeds into transportation, manufacturing, heating, and food production. Inflation spreads throughout the system. Central banks respond. Interest rates rise. Debt servicing costs increase. Government budgets come under pressure. Currency values fluctuate. In the late 1970s, the Iranian Revolution triggered a second oil shock. Production fell. Prices surged again. Inflation accelerated once more in the United States. Paul Volcker, then chairman of the Federal Reserve, responded in 1979 and 1980 by raising interest rates aggressively. The federal funds rate peaked above 19%. The result was a deep recession, but inflation was eventually brought under control. This is the chain reaction. Choke point crisis, commodity spike, inflation surge, monetary tightening, debt pressure. Sometimes inflation does not begin at the printing press. It begins in a narrow stretch of water, and the story does not end there. The Strait of Malacca, between Malaysia and Indonesia, carries roughly a quarter to a third of global trade. It also handles the majority of energy imports to China, Japan, and South Korea. It is one of the busiest shipping lanes in the world. If Malacca were blocked, energy-hungry Asian economies would face immediate supply shortages. Shipping costs would rise. Insurance premiums would surge. Markets would begin repricing risk within hours. Global finance reacts instantly to physical constraints. The Taiwan Strait represents another modern vulnerability. Taiwan produces more than 90% of the world's most advanced semiconductor chips through companies such as TSMC. These chips power smartphones, data centers, military systems, and financial infrastructure. In 2021 and 2022, pandemic disruptions and supply chain bottlenecks created chip shortages that affected automotive production, consumer electronics, and industrial equipment worldwide. Prices increased, production schedules slipped. Now imagine that disruption magnified by geopolitical conflict. If Taiwan's semiconductor exports were blocked, it would not only disrupt technology, but also shake the digital backbone of the global financial system. Markets may be digital, but trade is physical. The two cannot be separated. Even climate can create choke points. In 2023 and 2024, drought conditions lowered water levels in the Panama Canal, reducing the number of ships that could transit daily. Shipping delays increased. Transport costs rose. Supply chains had to be adjusted. Built in 1914 as a strategic masterpiece of American engineering and power projection, the canal became vulnerable to rainfall patterns. Globalization is not frictionless, it is conditional. What connects all these examples is not coincidence, it is compression. When global trade is forced through narrow corridors, leverage emerges, and leverage influences finance. When routes are threatened, insurance premiums rise. Commodity prices adjust to perceived risk. If inflation expectations increase, bond yields shift. When trade balances deteriorate, currencies move. Financial markets are not detached from geography. On the contrary, they are extremely sensitive to it. The more integrated the global economy becomes, the more critical choke points become. Integration increases dependency. Dependency creates vulnerability. Vulnerability creates pricing power. And pricing power translates into influence over inflation, monetary policy, and capital flows. The 2021 blockage of the Suez Canal by the container ship Ever Given served as a powerful modern reminder. A single vessel was stranded in the canal for 6 days. Hundreds of ships were delayed. Oil prices moved upward. Supply chains were disrupted. Markets reacted immediately. Just 6 days. Now imagine that closure lasting much longer due to conflict. In late February 2026, joint strikes by the United States and Israel targeted Iran's leadership. Iran's supreme leader was killed. Retaliation followed. Missile exchanges, regional escalation, and military buildup across the Gulf ensued. And markets moved instantly. Not because of ideology, not because of headlines, because of the Strait of Hürmüz. Nearly 1/5 of global oil consumption flows through that narrow passage. Tanker traffic slowed. Maritime insurance premiums surged. Energy futures rose on fears of supply disruption. This is not speculation, it is structural reality. When a choke point destabilizes, oil markets tighten. When oil markets tighten, inflation expectations change. When inflation expectations rise, bond yields move. When bond yields move, equity valuations are repriced. When valuations are repriced, pension funds, sovereign wealth funds, and household portfolios feel the impact. A missile launched in the Gulf can ripple all the way to your mortgage rate. Global finance does not respond to abstract threats. It responds to bottlenecks. We saw this pattern in the 1970s. We saw it during the Suez Crisis. We saw it during pandemic, supply chain disruptions, and we're watching it unfold again. Now consider the broader picture. Today's global economy is heavily burdened with debt. Public debt levels in advanced economies remain historically high. Corporate leverage is elevated. Households depend on mortgages and consumer credit. Central banks are navigating between post-pandemic inflation pressures and fragile growth. In such an environment, supply shocks matter even more. When debt is high, inflation becomes more destructive. When inflation becomes unstable, monetary tightening becomes politically painful. When tightening becomes painful, financial stress follows. Strategic choke points amplify this fragility. If oil flows are disrupted for weeks, energy importing countries face trade deficits. Their currencies weaken. Governments begin subsidizing fuel to prevent social unrest. Fiscal balances deteriorate. Investors demand higher bond yields to compensate for risk. A full blockade is not necessary. Uncertainty is enough. Financial markets price probability. Insurance companies price exposure. Central banks price expectations. The more fragile the system becomes, the more sensitive it becomes to geography. Now widen the lens further. The Strait of Hürmüz is not the only pressure point. Shipping routes in the Red Sea have faced disruptions due to regional conflict. The Panama Canal's capacity has been constrained by drought. The Taiwan Strait remains a geopolitical flashpoint directly tied to semiconductor supply chains. These are not isolated events. They are nodes within the same network. Globalization has concentrated efficiency. It has not eliminated risk. When trade routes were longer and more diversified, shocks spread more slowly. Today, supply chains are optimized for maximum efficiency. Just-in-time logistics reduce storage costs. Efficiency is high, but redundancy is low. The modern financial system assumes continuity of flow. When that continuity is threatened, volatility rises. Look at freight rates. During major disruptions in the pandemic, container shipping costs from Asia to Europe increased several-fold. Commodity prices followed. Consumer prices rose. Inflation reached levels not seen in decades in some advanced economies. Central banks tightened policy aggressively. Asset prices were repriced. Housing markets cooled. This entire chain reaction began with physical disruption. Strategic choke points do not create inflation on their own, but they can trigger it. They do not cause currency collapse by themselves, but they can accelerate capital flight. They do not guarantee recession, but they increase the probability of policy mistakes. And policy mistakes are costly. If there were a gold medal for assuming stability in an unstable world, policymakers would still be on the podium. But markets are not sentimental. They adapt quickly. When risk premiums rise on shipping routes, trade finance costs increase. When trade finance costs rise, profit margins shrink. When margins shrink, earnings forecasts are revised. When forecasts are revised, stock prices move. Behind every headline about geopolitical tension lies a spreadsheet recalculating exposure. This is why strategic choke points matter far beyond military analysis. They influence inflation trajectories, they affect interest rate policy, they shape sovereign credit ratings, they alter currency flows, and they remind us that global finance rests on physical infrastructure. For investors and citizens seeking financial freedom, this is not abstract theory, it is risk awareness. You cannot predict every crisis, but you can understand the structure of vulnerability. Ask simple questions. Where is essential trade concentrated? How dependent is your economy on imported energy or critical components? How exposed is your currency to commodity price volatility? How leveraged is the financial system when shocks occur? History shows that choke points do not disappear, they shift. The Hellespont mattered to Athens, Suez mattered to Britain, Hürmüz matters to today's energy markets, Malacca matters to Asian industrial economies, Taiwan matters to digital infrastructure. Control over these arteries confers leverage. Leverage creates negotiation power. Negotiation power shapes financial outcomes. Global markets may look digital, but the system still runs through narrow corridors of land and sea. When those corridors tighten, money moves accordingly. Strategic choke points have always shaped global finance because they compress trade into controllable spaces. Control over space translates into influence over supply. Influence over supply affects prices. Prices shape inflation. Inflation drives monetary policy. Monetary policy determines credit conditions. And credit conditions determine who prospers and who struggles. Geography does not care about ideology. It does not respect central bank independence. It does not negotiate with bond markets. It constrains. History does not repeat exactly. But geography rarely changes. The next time markets move sharply because of news from a distant strait or canal, remember this: finance does not float above the world. It is anchored to it. And if you want to protect your wealth in an interconnected age, you must understand not just balance sheets, but bottlenecks. If this gave you a new perspective, don't forget to subscribe. History holds the answers, and I will show you where to look.